Does anyone have a chapter 12 question that they would like to throw out? All right.
Practice 2.
Practice 2. So this one here?
Yep.
Okay. It's trying to determine its cost. Oh, wait, let's talk about a way that we should approach every problem. Number 1, figure out what they're asking. Number 2, think about what you'll need to find it. And number 3, read the problem looking for that info. So let's, we're starting with A, and it says, what's the company's pre-tax cost of debt? What do we really use for pre-tax cost of debt? I'll give you a hint. It has something to do with the bonds. Very good. The yield to maturity. That means we're looking for yield to maturity. So what kinds of things do we need for yield to maturity? We need the face value. We need the time to maturity. We need the coupon rate. And we need to know probably the current price of the bonds. So there are lots of things that we should be looking for here. They tell us the firm has a debt issue outstanding with 11 years to maturity. That's one of the pieces of information we're going to need. And it's quoted at 104% of face value. What's face value for this bond?
$1,000.
Very good. And so what's 104% of 1,000?
10,000 or 1,040. Sorry.
Very good. She's going into the law. She can do that in her head, right? That's not an insult. That's actually quite a compliment. Most lawyers can only figure out 1/3 of any number. Do you know why that is? That's what they get if they win, right?
Yeah.
Oh, yeah. Okay, so back to the story. 104 says 1040 makes semi-annual payments and has a coupon rate of 4% annually. How much is this thing going to pay annually in coupon?
$20.
That's semi-annually, right? You're skipping a step, right? So 4% annually is $40. We're going to divide by 2, and that's going to be 20. And now, so let's get our calculators out, and we're going to calculate the YTM. First thing to do, second, TBM. And I always put 1,000 in first as the future value because that's the face value. They didn't even tell us that, but we know. And then 1,040. I'm going to hit negative and put that in as the present value. Why did I hit negative?
Because of the error.
Yeah, it'll give me the error. It's a cash flow in the opposite direction. Now, what about the coupon? Ms. Gass said it was 20, right? So we're going to put 20 in for the payment. What should we put in for N? 22. Why 22 instead of 11? Semi-annual. Very good. Are we ready to compute I per Y? Yeah. There we go. Is that the yield to maturity?
No.
No. Why not?
There's a multiply by 2.
Yeah, you got to multiply it by 2. There you go. That gives us our 3.56%. Now the next thing they ask us for is the after-tax cost of debt. In order to know that, we have to know the tax rate. So here we go. Our after-tax cost of debt is equal to the before-tax cost of debt times 1 minus t. So we're going to multiply this times 1 minus 0.21. So multiply by, open parentheses, 1 minus 0.21. Close parentheses, equal. And that gives us our 2.81%. Does that make sense? Okay. Other chapter 12 problems.
Could you do number 5?
Sure. On the practice, right?
Yeah.
Start with practice, then we'll go to homework. Farmers Llamas has a weighted average cost of capital of 9.0. Oh, by the way, what are we supposed to do first? We're looking for the debt to equity ratio. I'm going to give you a hint. When you're doing one of these weighted average cost of capitals and asking for debt to equity, here's the fun trick. Remember, the weight on the debt is total debt over total assets. And the weight on the equity is total equity over total assets. Sorry. Weight on the debt, weight on the equity equal. And so what does this thing end up equaling? What happens to these TAs? They cancel out. So this actually gives you the debt to equity. So what you're really looking for here is the ratio of the weights. Does that make sense? Okay, so what we really have to find are the weights. And so we need to look at what kind of information are they giving us that will allow us to figure those weights. It tells us that they've got an average cost of capital of 9.2%. They tell us the cost of equity is 12%. And they tell us the pre-tax cost of debt is 6.6%. And the tax rate is 22%. So they've given us everything we need for our weighted average cost of capital formula except for the weights. And you're saying, wait a minute, we've got to figure out two weights using one formula. How are we going to go about that? Any ideas? What's that?
Whack.
Oh, yeah, we're definitely. And you're old enough to remember when Whitney Houston said that crack was whack?
Yes.
You are probably the only other person in this room that knows about that.
Would you take 1 minus?
Very good. She remembers that the weights have to add to 1. And so I'm going to make one of these things x, and I'm going to make the other one 1 minus x. So now instead of looking for two things, we're only looking for one thing. So I'm going to do a little erasing here, because we're going to be doing some big writing. Okay, so let's write out our formula here. R whack is equal to the weight on equity times the required return on equity plus the weight on debt times the required return on debt times 1 minus t. By the way, that's the after-tax cost of debt. That's all that is. Now, we said that we're going to have to replace one of these with x and one with 1 minus x. So I'm going to change this one over here to x and this one over here to 1 minus x. So that's the first thing that I do. Okay. And does it really matter which one I do as x? Not really, right? As long as you remember which one you did, you're good to go. Okay, so now they tell us that our WACC is equal to 9.2%. And notice, I've got this is going to be percentage, this is going to be percentage, and this is going to be percentage. As long as I leave all those three in percentage, then I'm fine. I'll use decimals for everything else. If you can't remember which ones need to be decimals and which ones need to be percentages, do it all in decimals. Bless you. And convert at the end. If you can't remember what all should be in percentage, what should be in decimals, then just do it all in decimals and convert to percentages at the end. By the way, do you think I would be so cruel as to leave the unconverted decimal as one of the choices? Absolutely, I would. Okay, now back to the story. That's equal to 1 minus x times, what's the required return on equity? Let's look. They're telling us it's 12%. So that's times 12% plus x times what's required return on debt before tax? Yeah, very good. 6.6%. And that's going to be multiplied by 1 minus, and what is our tax rate? 22%?
Yes.
Yeah. 0.22. That's got to stay a decimal. Now, I want you to notice something here. I'm going to cancel out these percent signs because they're in each of the terms. I can just knock those out. And so now I'm going to do some what we call distribution. 9.2 is equal to, what is 1 times 12? 12, very good. You guys got that wrong, I was going to be concerned. Negative x times 12, what's that? Minus 12x, very good. plus, so let's go ahead and consolidate this. What is 6.6 times 0.22? 6.6 times 0.22. Is that right? That looks right.
That's what I got. yeah.
Good, very good. Okay, now we're going to distribute that 1.452 here. So it's going to be 1.452x. Does that make sense? We multiply this and this together, and then we multiply it by x. Have I lost anybody yet? You're lost?
Not exactly.
Okay.
Why would you do it times 0.78, 6.6 times 0.78?
Oh, she's absolutely right. I screwed up. Yeah. Luckily, that screw up probably wouldn't have been in the multiple choice. Okay, she is absolutely right. I shouldn't say that. I messed up there. Okay, so she is absolutely right. Let's do that again. 6.6 times 0.78. There we go. Thank you. 5.148. Okay, does anybody have any idea what we should do next to try to solve for x?
Subtract both from both sides.
Subtract what from those? Oh yeah, very good. Okay, so we're going to say 9.2 minus 12 is equal to, and 12 minus 12, what happens? Just cancel out, right? Negative 12x plus 5.148x. Okay, she knows that we've got to get all the x's on one side and all the other junk on the other. What should I do next?
Take negative 12 plus 5.148.
Okay, negative 12 plus 5.148. So we'll say minus 12 here. Oh, bless you. And so this side is equal to negative 6.852 x. Does everybody else get that? Okay, now over here we've got 9.2 minus 12. Is that minus 2.8?
Yeah.
Okay, last step. How do we get x by itself?
Divide both sides by negative 6.852.
Very good. X is equal to minus 2.8 divided by minus 6.852. What happens to the negatives? They cancel out. So really all I've got to put in my calculator is 2.8 divided by 6.852. Is that what you get? Did I mess that up? I'm going to ask the person that got my last mistake. Did I mess that up? Excellent. Okay. We are all equally wrong or equally right. We will see. Okay. Now, we know that x is equal to, and by the way, I'm going to store 1 here, right? Store 1. That's my x. And then I'm going to hit negative plus 1 equal to, and I'm going to hit store 2. Why did I do that? Yeah, it's the other way, right? We said there was x and it's 1 minus x. So now we've got x in storage location 1. We've got 1 minus x in storage location 2. And to get the debt to equity ratio, what we're going to do is take x divided by 1 minus x. And so we've got this stored in location 1. We've got this stored in location 2. What should I do next? So recall 1 divided by recall 2 equals. I'm getting 0.691, which is exactly what they got. So, did that take a while? Yeah. If you see one like this on the exam, what should you do? Skip it and come back to it later. Now, there had to be a couple of things that you knew here. Number 1, you had to know that the weights have to add to 1. And you also had to know about this, oh, I've already erased it, where the weight of the debt over to the weight of the equity is TD over TA divided by TE over TA. What happens to those TAs? They cancel out and that gives you the debt to equity ratio. So those were really the two tricks, what we'll call them tricks. Those are the two things you needed to know to make this thing work. Questions? Okay, another chapter 12 practice question.
Could you do number 6?
Sure.
Sorry.
Oh, no worries. This is it? Yeah. You have the following information. I'm going to make this bigger.
I have a question.
Yeah.
On the last one,
Uh-huh.
why do we do like, it's like debt to equity, so you're taking like total debt divided by total equity? Why is it not like 1 minus X divided by X?
Well, it is. Remember
You know?
so we put X as the weight on debt over here. We replace,
Yeah, I'm following you.
okay,
Yep.
good question.
Okay.
Other questions? This thing has lost me again. I think it just likes looking at you for whatever reason. Okay, now, it's asking what is the WACC? So that's step number 1. What's the WACC? So what are the things we're going to need for WACC? We typically are looking for the weight on the debt, the required return on the debt, tax rate, the weight on the equity, and the required return on the equity. And they tell us that we have this 6,000 of these 7.3% coupon bonds outstanding with 1,000 par value, 15 years to maturity, selling at 109% of par. The bonds make semi-annual payments. Two things we're going to be able to calculate out of that information. Number 1, the required return on the debt, which is also the what of the bonds? Yeah, very good, the yield of maturity. And we're also going to be able to figure out what is the market value of the debt, which is going to be this TD thing that we need. Does that make sense? Okay, the common stock has 450,000 shares outstanding. It's selling for $63 a share, and the beta is 1.06. And then they tell us that there's a 12% market risk premium and a 5.3% risk-free rate. So that first bit, 450,000 shares outstanding at $63 a share, what's that going to give us? Yeah, it's the value of the equity, right? So it's going to be this TE. By the way, the weights are always in market values, never book values. The weights are always in market values, never book values. Okay, now what about beta, market risk premium, and the risk-free rate? What equation can we slip those things into? Very good. The security market line, and the security market line gives us what? Yeah, the required return on equity. So now we have enough information to figure out not only the amount of equity, but also the required return on equity, the amount of debt, required return on debt, and did they tell us? They tell us a tax rate there, and so we're going to be able to use that in our WACC equation. How are we going to get the total assets?
Well, it gives you the total debt, right?
Right. And
So-
what else does it give us?
Does it give you total equity?
Well, what we just said, if you multiply 450,000 shares times 63, right?
So then you just add them together.
Yep, you just add them together. Does that make sense? Okay, so let's actually start digging into this. I'll tell you, the first thing I want to try is to figure out the yield and maturity of the debt. And I'm going to erase this board. By the way, if you really want to do the universe a favor, invent a self-erasing board. I would even give you some seed money to get started if you show me a working prototype.
They have them in China.
Damn, that's good to know.
And
When?
it erases it, but then it also captures pictures of it. And it loads
Sweet.
it to the cloud.
Sweet.
They're beautiful.
I'll have to talk to Dr. Reagan to see if we have money for that sort of thing. I can tell you the answer right now. No. People are always talking about stuff that they want to do here at the university. I'll be in a committee meeting and they'll say, oh, let's do this, let's do that. I'm like, that's a great idea. And then I turn to the assistant or associate dean and I say, is there any money for that? And she says, no. And then we move on. Okay, now, let's talk about this. First thing we're going to figure out is the yield of maturity. So that's going to be the required return on the debt is equal to the yield of maturity. Let's figure that out. Get your calculator out. What's the first thing we do when we start messing around with TBM keys?
Second clear TBM.
Second, clear TBM. These are making semi-annual payments, but the easy thing to put in is 1,000. Future value, did I even have to tell you it was $1,000 par value? Nope. What do we put in for N?
30.
30. Why 30 instead of 15?
Because it's semi-annual.
Semi-annual. And then selling for 109% of par. What is 109% of 1,000?
1,090.
Yep, 1,090. But what button should I hit before hitting PV? Negative. Cash flow in opposite direction. Now we need to figure out the coupons. Coupons are 7.3. Oh my goodness, that's a pain. So let's say we know it's 73 per year. Divide by 2 equals 3650. I'm going to put it in for PMT. Did I lose anybody there? Okay, so what we did is we said that 7.3% gets paid annually in coupons. 7.3% of 1,000 is $73. But it gets paid out in 2 little payments. So we're going to divide it by 2, and that's why it is what it is.
Why don't you do it times 6,000? Like it says 6,000.
Oh, we're not there yet. We're just trying to figure out the yield and maturity at this point. When we start trying to figure out the market value of the debt, we absolutely will. Question? Okay, by the way, I could multiply the face value, the payment, and the price all by 6,000, and I would end up getting exactly the same answer. Just if you want to, play around with that later, like, when you get bored. That's not going to happen, right? Okay, so, are you with me so far? So what do we compute now?
I will.
Yeah, compute I over y is, oh my goodness, is that correct? Is that what you got?
No.
Okay.
I think you did second.
Oh, whew. So, compute present value. Oh, sorry, that's not what I'm trying to do. Okay, I'm going to start over here. 1,000, boom. 36.5, boom. 1090, negative, boom. 30, and compute I per y. Is that what you get?
Yeah.
Okay, now, is that the yield of maturity?
No.
No. So I'm going to multiply by 2. This is our yield of maturity, and I'm going to store that in location 1. I'm going to go ahead and write it down here. 6.36%, but that's not perfect. It's rounded, but I'm going to mark it as location 1. Are you with me so far? Now we need to figure out what is the total debt. And the total debt is going to be the number of bonds times the price of the bonds. How many bonds do they say that we have? 6,000. Times, they're 1,090 apiece. 6, 1, 2, 3, multiplied by 1,090 equals. Is that what you get?
Yes.
I'm going to store 2. Okay, and then we also have the tax rate, but we'll throw all that into our equation here in a bit. Now they also tell us that they'll give us lots of information here on the common stock to figure its required return. So the required return on any stock is equal to the risk-free rate plus beta for that stock times the expected return on the market minus the risk-free rate. Does that look correct? Okay, now we have a special name for this little piece right here. What is it?
No, I just had a question.
Okay.
About the total debt.
Okay.
I was lost on a step. I was catching up with you.
Okay.
For the last part right there,
Uh-huh.
you got the 6,540,000. How did you get that?
Okay, so what I did is I took the 6,000 bonds,
Okay.
and they're each worth 1,090. And so 6,000 times 1,090, does that make sense?
Gotcha.
Cool. Yeah, if I leave you behind, let me know. I'll let him get that figured out. And by the way, store at location 2. Now, can someone tell me what the other name for the expected return on the market minus the risk-free rate is?
Market risk premium.
Yeah, it's the market risk premium. So this thing is the market risk premium. So they tell us the risk-free rate. What is it? 5.3%. And once again, if you're confident in knowing that you're not going to mess this up, you can play in percentages. Otherwise, convert it to decimals and convert it back. And then they tell us that beta is how much? 1.06. And we're going to multiply that times the market risk premium, which they tell us is 12%. Okay, and that's percentages too. So let's get our calculator out. First thing I'm going to do is multiply 12 times 1.06. It's just order of operations. Plus 5.3 equal. I'm getting 18.02. Is that what you're getting? Okay. I really need you paying attention so you'll catch my next mistake. Okay. Now, so we're up to 18.02%. What memory location do you think I'm going to do?
3.
3. Very good. Store 3. Okay, now we got one more thing we got to figure out. We have to figure out what is the total value of the equity. Any ideas on how we're going to do that? Ms. Flowers. No. Okay, swing. Well, she didn't even swing. Ms. Hofstadter.
Shares outstanding.
Very good. It's the shares outstanding times the share price. How many shares are outstanding? 450,000. And how much are is each share worth? $63 per share. $450,000 times 63. I'm getting 28,350,000. Is that what you're getting? Okay, let's go and write that down. 28,350,000. And we're going to store that in memory location 4. Store 4. Okay, now to figure out our weight on debt, we need total debt over total assets. Do we know total assets yet? How are we going to get it?
Total.
Very good. So total assets equal total debt plus total equity. That is equal to 6,540,000 plus 28,350,000. Is that right? But where have I got these things stored? I've got this stored in 2, I've got that stored in 4. So I'm going to say recall 2 plus recall 4 equal. I'm getting $34,890,000 bucks. Is that what you guys are getting? So $34,890,000. Any idea where I'm going to store that?
5.
Yep, location 5. Okay, now I can go ahead and figure out this. And we know that this is just location 2 divided by location 5. Does that make sense? How am I going to do that in my calculator? Mr. Rich, how am I going to do that in my calculator?
You could recall.
Yep, recall 2 divided by recall 5 equal. Is this what you're getting? Okay, so 0.187, da, 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 da. Now, a lot of students will just write down 0.187. They'll say, yeah, that's probably good enough. Probably not. So what are we going to do? Store 6. And then,
You don't need to clear your storage each time whenever you're doing these calculations.
oh, no, because it just writes straight over the old stuff. Absolutely. Did you hear the question? She says, do you have to clear your memory locations each time? You absolutely do not. It's easy on the one side because you don't have to do that. On the other side, you can overwrite things if you're not careful, which is why it's important to write these numbers out. And of course, then to be able to refer back to them. Good question. Other questions? Okay. How are we going to figure out the weight on equity?
Total equity divided by total assets.
Very good. Total equity divided by total assets. Total equity, we've got in location 4. Total assets, we've got in location 5. Whew, it's a good thing we don't have any more stuff to calculate or we'd run out of locations. Okay, so we're going to say recall 4 divided by recall 5 equals store, what are we going to call this one?
Store 7.
Yep. I'm not even going to write the number down. Did you get .8125? Okay. So store 7. Now, here's something I want to show you. Recall 6 plus recall 7. What should it be equal to? 1. If it's not, you've got a problem. Go back and work on your stuff. Whew! I think we may finally be ready to calculate whack. We know that our whack is equal to the weight on equity times the required return on equity plus the weight on debt times the required return on debt times 1 minus t. Does that look familiar? Say yes if it looks familiar. Okay, very good. Now, where have we got weight on equity saved? It's location 7. Where have we got return on equity saved? Location 3. Where have we got the weight on debt saved? Location 6. Where have we got the required return for debt saved? Oh, come on, you can read the board, can't you? Where do we have the required return for debt saved? 1. Very good, thank you. Times 1 minus t. T is, do they tell, they have to tell us, right? Assume the company's tax rate is 0.24%. So this part is 1 minus 0.24. To avoid screwing up like I did last time, I'm going to go ahead and just do that math and then write it in. What is 1 minus 0.24? It's 0.76. Okay, are you ready to try to do this thing? Ms. Flower says, of course she is. Okay, so I'm going to hit clear. And this one's got, no, I won't confuse you that way. So let's do 7 times 3. Recall 7 times recall 3. Is that what you get? Okay, so I'm going to save this in location 8. And then the other one is recall 6 times, recall 1 times 0.76 equals, is that what you get? Okay, and where do you think I will store it? Yeah, store 9. Now, all I have to do to figure out whack is add 8 and 9 together. So, recall 8 plus recall 9 equals, I'm getting 15.548%. Yep, that's what it is. If you run into one of those on the exam, what do? Skip it. So, we had to literally figure out everything from something else that was given, except for the tax rate, right? That means multiple steps, many opportunities to make a mistake. So, I would tell you to skip this one, and this will probably be the very last one that I would do on the exam, because simply there's just so much work involved in getting to the end. How can we avoid mistakes? You see all these numbers that I've stored in the calculator? That does a couple of things. Number one, it avoids rounding error. Number two, it avoids me writing things down wrong. And number three, it avoids me tabbing things back in wrong. Plus, it just saves me time. Oh my goodness, that was so much faster to do it with the store and recall than it would have been to write it down and retype it. Does that make sense? Okay. Any more questions from Chapter 12 practice?
Yeah, I thought we had my bad, but just one of those things for 0.76. What was the T? I got down.
Oh, so the tax rate, it says up here that the tax rate is 24%.
Oh, yeah.
So 1 minus 0.24 gives us 0.76. Good question. Now, why didn't I leave it as 1 minus 0.24? Because earlier I screwed up. She caught me. I was pleased. But I screwed up. That's why I did it. And then, by the way, is there a chance you'd screw up too?
Yeah.
Oh, yeah. We're all human, right? Questions?
You want to do number 7?
Oh, I would love to do number 7.
Okay.
Let's see. So what's our number one thing we're supposed to do? Figure out what they're asking for. So they're asking, what's the firm's market value capital structure? What do they mean there? They're wanting to know what part of the capital structure is debt and what part is equity based on market values. Remember, we're always talking about market values, not book values, when we actually calculate this sort of stuff. If the company is evaluating a new investment project that has the same risk as the firm's typical project, what rate should they use? Remember in Chapter 12, we said that if a project was riskier than the rest of the firm, it would not be good to use the same cost of capital. We would need to use a number that was higher. And if it's safer, we'd need to use a number that's lower. But if it's just like everything else, and my example was the Nissan Altima, what did we say we could use as the required rate of return for the project? I see a spark of inspiration here. She's having to return to her notes. Does anyone actually know this?
Was it?
Oh, swinging a miss.
Yeah.
If a project is equally risky as the rest of the firm, what number or concept can we use as the discount rate for that project? Whack! Very good. You are on fire. Thank you. Okay, so we can use whack. So what B is really asking for is whack. Do we know what sorts of things go into whack? Yeah, we do. Okay. Now, and by the way they're doing this this capital structure, those are actually the weights, right? It's that top one is total debt divided by total assets. The bottom one is total equity divided by total assets. We might also call that the weight on debt and the weight on equity. And so we're actually going to need those two things in order to get to the second question anyway. Are you with me so far? So now we're going to read back through the problem and figure out what we've got there and how we're going to use it. 9.2 million common shares outstanding and 360,000 bonds. And they're telling us that common stock sells for $40 a share, and then they give us its beta. They also tell us that the bonds are selling for 111% of par. And so with those four pieces of information, number of shares, price per share, number of bonds, price per bond, we can figure out the total debt and the total equity of the firm. And if we add those two things together, what do we get? Yeah, the total assets. And so then all we're going to do for a total debt there is TD over TA, or the debt is TD over TA, and the bottom one is TE over TA. So let's go ahead and do that work. I'm going to leave this up here because we'll use it again. Okay. Total debt equals, how many bonds are there?
160,000.
360,000. And how much are they selling for? The bonds have 15 years to maturity and sell for 111% of par. What's par?
$1,000.
1,000. So what is 111% of that?
1,100.
1,110, right? Oh, that's not what I wanted to do. I was just having a good time with my zeros there. Okay, 1,110. Are you with us so far? Okay. Now, I could go ahead and multiply that out and get my value of debt. So let's get our calculators out. 360,000 times 1110. I'm getting 399,600,000. Is that what you're getting? Okay. 399,600,000. And can you guess what I'm going to do with that number? Store one. I'm going to mark it as such. Total equity. How many shares are outstanding?
360,000.
Oh, that's bonds.
Oh.
9.2 million, right?
Yeah.
And what's the share price? 40. Very good. Nine two oh 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 oh. 9.2 million times 40 equals 368 million. Any idea what I'm going to do with that number?
Store 2.
Yep. Store 2. Now, how can I figure the total assets?
Add them together.
Yep. Total debt plus total equity. So we've got 1 plus 2. Recall 1 plus recall 2 equals, I'm getting 767.6 million. Is that what you get? You know what I'm going to do with that? Store 3. The weight on debt is equal to total debt divided by total assets is equal to 1 divided by 3. Have I lost anybody here?
Yeah, so, my bad. So 40, where'd you get that 40 from?
Okay, so that's the price per share.
That good.
Yeah, and it's up there in the problem statement somewhere. My calculator keeps moving around and hiding stuff. I'm sorry about that.
I got it, next time.
Okay. So we stored total debt in location 1, we stored total assets in location 3, and we're going to say recall 1 divided by recall 3 equals. And it's going to give us 0.52. What do you think I'm going to do with that number? Store 4. And the reason I'm storing it is because we're going to use it later over here. Does that make sense? Okay. Now, if I were running short of time and I were fairly sure of what I had just calculated, what could I do for the weight on debt? Yeah, you just take 1 minus. But we've got this, weight of equity. So we've got this, and it's just recall 2 divided by recall 3. Recall 2 divided by recall 3 equals, I'm getting 0.4794. And I'm going to store that in location 5. Now, how can I check my work for these?
Recall 4 plus recall 5.
Yeah, recall 4 plus recall 5, and what should it equal?
1.
Yep. There you go. Whew, so far, so good. Now, we've got the weight on the debt is location 4. We've got the weight on the equity is location 5. And we know the tax is 22% over here. So the only things we're missing are the required return on equity and the required return on debt. Let's start with the required return on debt. What are we actually looking for here from the bond perspective?
Yields.
Yeah, it's the yield of maturity. Okay. So, let's get our calculators up here. What's the first thing you always do when you're going to calculate bond stuff? Second, 3rd TVM. Very good. Okay, then let's look at what we've got here. They're selling for 111% of par. So I'm going to say 1110 negative present value. Let's see what else we've got here. They tell us the bonds have 15 years to maturity. Now, do they? Nope, they do. They say semi-annual bonds. Bless you.
Thank you.
Semi-annual bonds, 15 years of maturity. What is N?
30.
30. And they also tell us the coupon rate is... They tell us? They have to tell us. Oh, here it is.
5%, yeah.
5% semi-annual bonds. So what is the payment? If they were annual, it would be 50. But it's semi-annual, so it's 25. And we put in our 1,000 for future value. I believe we're ready to calculate I per Y. I'm getting 2%. Is that the yield of maturity?
No.
No. What do we need to do?
Multiply by 2.
Yeah, got to multiply by 2. That gives us the yield of maturity. And let's see, what number should I say that as? 6. Dang, store 6. And so we're going to store, and that was the required return on debt. We're going to store that as 6. Now we only need the required return on equity. And they tell us the beta. So how are we going to calculate that required return on equity?
Is that beta times MRP?
Okay, so it's the security market line,
Okay.
right? And that formula is R sub B is equal to R sub F plus beta times expected return on the market minus the risk-free rate. And that whole thing is the market risk premium. Now, what information do they give us? They tell us that beta is 1.6, is that correct? And they tell us that the T-bills are yielding 5%. Why do we care? What are we going to use that number for?
Risk-free rate.
Yeah, it's a risk-free rate. 5% plus 1.6 times, and they tell us the market risk premium. Do we need to subtract R sub F? No, it's this thing right here. And so what's the market risk premium? 8%? Wow, this is actually getting quite easy. So we just say 1.6 times 8 equal, that's 12.8% plus 5%. If I do that math in my head, I think it's 17.8%, but let's make sure because I'm going to store it anyway. Oh, that is not right. There needs to be an undo button on these things. Plus, not multiplied by. There we go. And I'm going to store that in location, any guesses?
7.
7, very good. So I've got this stored in location 7. And what is T?
0.22.
Yeah, 0.22, so this is going to be 0.78. That's just 1 minus 0.22. You can do it in your calculator if you want. Okay, how should we approach this? Either way, it really doesn't matter. Recall 5 times, recall 7 equal. I'm getting 8.533. Yeah, 534, something like that. But you know what I'm going to do with that number? Store it in location 8. And then I'm going to say recall 4 times recall 6 equals times 0.78. What do you think I'm going to do with this number? This isn't rocket science at this, folks. I'm going to store 9, right? Okay, now how am I going to get weighted average cost of capital? How am I going to get the weighted average cost of capital?
8 plus 9.
Yeah, recall 8 plus recall 9 equal. I'm getting 10.16%, which happens to be the answer. I can tell she's skeptical. Do you have questions?
I don't think so.
Okay, anybody else have questions? Are you good?
Yeah, you're going to be posting stuff online.
Yeah.
Okay, for sure.
Yeah.
Okay.
Now, I can't guarantee you how much of the board you'll be able to see, but you can go back and look at this and work through with as I talk things through. Oh yeah. Questions? Okay. Anything else from chapter 12?
You wanted to work 8. That'd be awesome.
Okay.
Will you post the questions you were gonna
Oh,
go
yeah.
over with us?
I think we've probably covered them.
Okay.
I mean, we've done most of them.
Yeah. Okay. You haven't noticed her tactic?
No.
She's just working me through the whole
I
damn
know.
thing. Okay. Now, first of all, number 1, what are they asking for? Yep.
Question 8.
What are they asking for? They're asking for weighted average flotation cost. Is that the same as WACC? No, this is WAFC. It doesn't even spell anything, right? It's WAFC. And they're looking for that in a percentage. And they ask what's the true cost of building the new assembly line after taking flotation costs into account. Okay, now this is from the very end of chapter 12, where we said when we go outside to raise money, we have to spend money to do that. We have to spend these things called flotation costs. And we always add them to the time zero cash flow of our project. And so what this thing is really asking us for is that time zero cash flow. Pardon me. Suppose your company needs $18 million to build a new assembly line. Your target debt to equity ratio is 0.8. The flotation cost for new equipment of new equity is 11%, but the flotation cost for debt is only 8%. Your boss has decided to fund the project by borrowing money because flotation costs are lower and the funds needed are relatively small. Now, if you go back and look at chapter 12, what we say is, no matter how you actually raise the capital, you should always be assuming that you are going to raise it in the same proportions as your current capital structure. And the reason for that is we want to maintain the same capital structure over time, assuming we're at the optimal capital structure. If I keep issuing new debt, that total debt to equity is going to start dropping or rising over time, right? It's going to pull us away from that capital structure that we desire to keep. And so we're always going to assume that we raise in the same proportions that we currently have. Now, oh my goodness, we're going to have to do some math here to figure some things out. First thing we're going to try to do is figure out what are the weights on debt and equity. Okay. Now, what information do they give us that will allow us to figure out the weights for debt and for equity?
Target.
Yeah, it's that target debt to equity ratio of 0.8. So, TD over TE is equal to 0.8. Now, I could go through a bunch of crap and show you about doing substitutions and things like that, but here's what I want to do instead. If you think back to chapter 3, remember that we said total asset, equity multiplier. The equity multiplier is total assets divided by total equity, and that is just equal to 1 plus the debt to equity ratio. Do you guys remember that? Ish? Okay. So, 1 plus that, so it's 1.8. And so that's total assets over total equity. If I flip that thing, I've got total equity over total assets is equal to 1 over 1.8. Are you with me so far? Now, if total equity is 1 over 1.8, what does total debt have to be? Total debt over total equity, or total assets, sorry. We know that these things have to add to 1, right? And so if I say total debt over total assets is equal to 1 minus total equity over total assets, that's equal to 1 minus 1 over 1.8. Here's the fun part. Equal to 1.8 over 1.8. Is that the same as 1? Yeah. Minus 1 over 1.8 gives me 0.8 divided by 1.8. Now, what is this really, if you wanted to write this down in a way that would make it easier for you to remember, you could say, well, the total equity is always, this weight is always just 1 over 1 plus the debt to equity ratio. And then this other thing is the bottom minus the top, which is 0.8 divided by 1.8. That would be the easiest way to remember this. Play with this at home. Make sure you understand it, because this is the easiest way to do weights. Okay, now that we have those weights, we know that our weighted average flotation cost is equal to the weight on equity times the flotation cost of equity plus the weight on debt times the flotation cost of debt. That's supposed to be a C. Okay. The flotation costs, they give us in percentages. And so what we've got here is the weight on equity is 1 over 1.8 times, what do they tell us the flotation cost of equity is? 11%? Plus 0.8 divided by 1.8 times, what's the flotation cost of debt?
8%?
Yep. So, here we go. Get your calculator out. This is really just 11 divided by 1.8. Do you see that? 11 divided by 1.8 equal 6.11111. And what do you think I'm going to do with that number? Store 1. I'll be right with you. Yes?
How do you get 11? On top for 11, say 11
Oh,
divided by-
it's the flotation cost for new equity. It's right there.
Okay.
Other questions? Where did I get the 8?
Flotation cost.
Flotation cost for debt, and it's right, bleh, right there. Okay. So now I've got this number. That's my weighted average flotation. Oh no, that's just the first part. Now the second part. 0.8 times 8 divided by 1.8 equals. I'm getting 3.555. Goes on forever, right? What am I going to do with that number? Store 2. Now I'm going to say recall 1 plus recall 2 equal. I'm getting 9.66. Is that what you guys are getting? Now I'm going to store this in location 3, but I'm going to save it as a decimal. So how do I get this into a decimal from here? This is percentage, by the way. How do I convert that into a decimal? Yeah, very good. Divide by 100. And I'm going to store that in location 3. Are you with me so far?
Well,
Yes, what do you got?
I mean, in this one, how we get the 6.1?
How we got the 6.11? We took 1 times 11 and divided by 1.8. So it's just really 11 divided by 1.8. Does it work for you? No? It sounds pretty.
Yeah.
Oh, very good. I was going to say, it sounds pretty right to me. Okay, now, the weighted average flotation cost, and by the way, that's question A, 9.67%. Did we get that right? Yeah. Okay, now, the next thing you need to know is to remember from our slides that the amount to be raised is the amount needed divided by 1 minus WAFC. How much do we need for this project? 18 million. And then 1 minus, and we've got that stored in location 3. So here's what I'm going to do. I'm going to do that bottom part first. 1 minus, recall, 3 equals. That's what I've got on the bottom. Now, it's on the bottom, but right now in my calculator it's on the top. How can I throw it to the bottom? Do you see that button, 2 buttons above 9? It says 1 over x. Whew. I just flipped it. And I'm going to multiply by 18, and that gives me 19, and it gives me the number that we've got there, right? Mine's just in millions, theirs is in dollars. Only difference between those. Now, if you missed out on that whole flip thing, what you could do is save this as location 4, and then just put in your amount needed and divide by recall 4. You could do that. Wouldn't be a problem at all. That 1 over x key is really, really handy for just putting stuff on the bottom. Questions? By the way, most common mistake, someone would multiply these two things instead of dividing. And the way you know if you've screwed up is if the amount that you need to raise is actually less than the amount that's required for the project. That's not going to work, right? No one's going to go out there and give us extra money. And so we've got to always raise more than we actually need because we have to pay the investment banker. Questions?